talk about IT services as a space. Now, Sandip Agarwal is with us, fund manager at Sowilo Investment Managers. Sandip, good morning. Good to have you here. Prashant on this side. Now, IT, 2 weeks back, it was looking like it was not correcting. It was down about 8% from the highs. Last 2 weeks changed all of that. It lost another 10%. So we're down about 18, 19% from the highs for the IT index itself. The other question more recently, of course, is if the US market starts to come off and growth indicators, etc., are moderating, what will it mean for the market as such? Specifically, what will it mean for the IT services sector? So just start with that basic point. We've had very strong US economy and markets for a few years. And for the first time, we are starting to hear that maybe things are going to go in the other direction for a while, maybe temporary, we don't know. How does it affect IT services companies from here, where they are already? Sandip. You'll have to unmute yourself, Sandip.
Yeah, hi, good morning, and thanks for having me on the show. So, Prashant, if you recollect our earlier conversation just 18-20 months back, when there was gloom and doom in the industry, we were extremely constructive and we were very positive. Last 5-6 months back, if you see all my interactions, I have been saying that, all the positives are baked in, but any kind of negative which can come, and if it at all comes, then we will be in a difficult spot. Now, Indian IT has a more than 95% market share globally in the outsourcing part, if you exclude the BPO piece. So we are very strongly positioned when it comes to execution at a reasonable price. But remember, when US economy was doing well, we were hurt very badly because of the disruption which was happening on the AI side. Because whenever disruption happens, the biggest task which Indian IT companies have, they have to, train their whole workforce into that new technology. And by the time when we are 2/3 in that journey of training, we are now seeing early signs of some weakness in the US economy. So, because Indian IT is priced to perfection and one of the cash flowing sector, no one leaves this stocks easily. And there are gaps in 2 or 3 years period of 2-3 months when you get them dirt cheap. And that gap, I think 18-20 months back was there. Now, I think, large part of correction has happened, but I still believe there is some more correction which will happen. The primary reason of saying this is that, no negative news from Trump at least has come yet on the sector. And Trump being Trump, you cannot take him for granted that, he won't do anything in such a big exporting sector. You remember 2014-15, all these localization things came and he enforced that we have more than 50% local employees and all, and that wiped out the margins of the Indian IT companies because local employees are hard to get and very expensive. So nothing can change that. Although, I can tell you that there is no one who can execute at this price in the US, and ultimately the US consumer will suffer very badly if any harsh step is taken on Indian IT. But having said so, politics being politics, you cannot take a call on either side.
You're talking about making it more expensive, sort of tougher to hire Indian workers. I mean, on that side, right? On HR side. You're not talking about a tax on services or anything in that sense.
I don't think it will be tax or services, but it will be more like, he may put in some more condition that you have to hire more local employees. And that becomes very difficult because it is in that market, employees are not available. So if you have to hire more, those few number of employees are chased by more number of employees. So the salaries and the outflows start going up, putting a dent on the margin. So the cost of doing business can go up. That is all I'm trying to say.
Okay. All right. Sandip, good morning and thanks a lot for joining in. Well, FY26 growth forecasts are mid to high single-digit growth. The recovery, though, has been gradual. Do you think we get back to, say, double-digit growth from FY27 onwards?
I think so, because, in FY26, what will happen, all your training of AI workforce will be broadly over. So after that, we will get some benefits. So low double-digit growth or high single-digit growth is something which FY27 can obviously deliver. But with similar margins. So in that case, what multiple you assign is a very important question. I think the large names like TCS, TechM, and HCL, Infosys, Wipro, they are broadly corrected and the time correction is also done. So I think some money could be there. But some of the names still are very expensive in the mid-cap space where, we have little less comfort and we believe if cost of doing business goes up, then there is some risk.
But so you're saying there's some more correction ahead, perhaps in large cap IT names. And then the basic question, Sandip, I mean, even if someone decides to buy IT, it'll probably be for other reasons, for instance, cash, safe haven, etc. In terms of growth, can we hope to buy anything more than 5-6% growth or 4-5% growth in these companies? Next 2 years, say, will the growth numbers look the same or do you see some improvement?
No, I think FY27 will be better than FY26 by 2 to 3% at least.
Which means how much growth in FY27?
So around 8 to 12%, depending on the size of the company, is what I see in 27, but not in 26. In 26, I am more like 6 to 8.
Okay, but that's good. 6 to 8% growth in 26, and maybe 12% in FY27. Don't remember the last time we were in double-digit growth. So then leave us with some top picks. If someone has that at least 1 year time horizon, if not longer, then what would be your top picks that you would perhaps be convinced on?
So we run a PMS. I will not give stock-specific name, but I will give you a flavor. So, in the large cap, there are few stocks which are now reasonably priced at 16, 17 times 1 year forward. Those are the stocks which you can start looking at. And in the mid cap, other than the ER&D space, if you are getting something at 18 to 20 times, so PEG ratio of 1.25, 1.5 is something we can start looking at. And in ER&D, you have to give obviously minimum 2 times PEG ratio, because that is a space which will do more than IT services growth for next decade. So you will have to pay a higher premium there. So we clearly see ER&D as a very good play for a longer term if we get at a right price. And within the mid cap and large cap on the IT services, we will be willing to give around 1 to 1.25 PEG ratio. And whenever stocks are coming in that range, it is an attractive level in my view.
All right, Sandip, we'll leave it there. A shorter chat today, but very, very useful in these volatile times, and gives us a broad idea about how to think about the space. Thank you.